Hello and welcome to Morning Markets. I'm Roger Peterson. Thanks very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Canadian inflation saw a contraction last month. Data from StatsCan shows the consumer price index fell to 2.2% in October compared to the month before. Economists were expecting a rise of 2.1%. StatsCan says the deceleration was driven by cheaper gasoline and grocery prices. The agency notes, however, that there was a rare increase in cellular service costs, 7% last month, the segment's first price hike since April of 2023. Prime Minister Mark Carney's government faces a confidence vote on its budget today. The budget proposes spending increases for defense, housing, and new infrastructure projects. It also made headlines for running a deficit of almost $80 billion in 25-26. To avoid an election, the Liberals need to have at least 2 votes from opposition members or 4 opposition member MPs to abstain from voting. We're tracking shares of Novo Nordisk today. The pharmaceutical giant cutting the price of its blockbuster products Wegovy and Ozempic for existing cash-paying patients. In a move that undercuts rival Eli Lilly, Novo says doses of the popular weight loss and diabetes drugs will be available for 30% less than their current price. Cuts are geared toward making its drugs more competitive with copycat medicines and rival Eli Lilly. And taking a look at the markets, a bit of red everywhere we look right now. TSX off by 0.16% south of the border. Everybody's just kind of sitting around waiting to see what happens next. Some big earnings coming up this week. But right now, S&P 500 off by 0.27%, Dow Jones by 0.25%, and the Nasdaq the same, off by 0.25%. Canada's inflation cooled by less than expected last month, supporting the BOC's move to the sidelines after back-to-back rate cuts. Let's get more on this now from Michael Davenport, senior economist at Oxford Economics. Michael, thanks as always for joining us.
Good morning. Thanks for having me.
Any real surprises here along the lines, close enough?
So, yeah, I would say along the lines of what we were expecting in the broader consensus, a little bit stronger. So overall inflation, whether you look at core inflation or headline inflation, both measures were a little bit firmer than the consensus expectation, but nothing too surprising, nothing too out of line with the overall consensus. I would say broadly the inflation story remains somewhat similar to what it was last month.
And just a few individual things that kind of stood out. Gas, a big driver on this one, wasn't it?
Yeah, absolutely. So if you look at what drove the deceleration in headline inflation from 2.4% year over year in September to 2.2% in October, the primary contributor to that was lower gasoline prices. So prices at the pump fell 4.8% month over month in October compared to September. Now that largely reflected lower global oil prices, but also lower domestic gasoline prices because of the switch to slightly different types of fuels. So that was a main driver. We also saw a little bit slower food inflation compared to September. So overall food inflation slowed from 3.8% year over year to 3.4% year over year in October. That was another key contributor to the slowdown in headline inflation last month.
I imagine welcome news for the average Canadian, both of those, seeing a bit of a drop or a slowdown, shall we say.
Yeah, absolutely. I mean, energy prices have fallen quite a bit over the last year or two, particularly after the removal of the consumer carbon price last April. We saw another big drop in energy prices, and that's largely continued through the second half of 2025 here. Now, on the food inflation front, while food inflation did sort of edged down from October. Overall, the trend in food inflation has been higher. So if you look at grocery price inflation, it has been running above the overall headline CPI inflation rate for 9 consecutive months. And so while the rate of increase in food prices might have eased relative to last month, there's still been a rising trend in food inflation, and food prices are still quite high.
So still worrisome. And also, a key thing for so many people, their phone bills went up.
Yes, exactly. So that was one of the major one-off factors that led to the increase in core inflation last month and prevented headline inflation from falling as sharply as some had expected, certainly as the consensus had expected. So cell phone service prices rose about 7.7% month over month, year over year. And that compares to a year-over-year increase of 0% in September. It was actually the first year-over-year increase in cell phone services prices since 2023. So again, that's definitely something that consumers were feeling in October.
And I don't have the numbers in front of me, but homeowners got a bit of a hit too with insurance. And I'm trying to remember what the second one was. The number's not in front of me right now.
So another one-off factor that led to the increase in core inflation in October was property taxes. So property taxes and other special charges increased by about 5.5% or so year over year. Now, property tax increases factor into the CPI every year in October. So this was expected. And actually, it's a slightly smaller increase in property taxes than we saw in 2024. In addition to that, as you mentioned, insurance premiums, so passenger vehicle insurance premiums in particular, remained quite high and continued to be one of the largest contributors to overall inflation in October.
Anything caught your eye in all of this in the new report beyond those things?
Yeah. So overall, as I mentioned, what we did see is a larger than expected increase in core inflation. And that in part reflected a somewhat surprising increase in rent inflation. So if we look at the rental component of the CPI, it rose 5.2% year over year in October. That's up from about 4.8% year over year in September. Now, the reason that this is somewhat surprising is because it is actually out of step with other data sources that we have on actual asking rents, so market-based rents across major cities, which show actually rents that are down on a year over year basis and much weaker rental price inflation picture than what the CPI seems to be reflecting. And so that was another factor that led to higher core inflation in October. But again, we think that overall rent inflation will slow in the CPI as it sort of realigns with what we're seeing on the ground and from other data sources, which show much weaker actual rent inflation.
So probably just a blip for now. And then one last question, of course. Bank of Canada, where does this leave any potential rate cuts?
Yeah, so that's a great question. Overall, as I mentioned off the top, we don't think that this materially changes the inflation picture, and we don't think it will really change the Bank of Canada's thinking all that much. If you look at the Bank of Canada's communication in its October monetary policy report, the press conferences around that, as well as in the summary of deliberations from that monetary policy decision that were just released last week, it's clear that the Governing Council feels as though the level of interest rates is currently at about the right level to keep inflation near the 2% target where it currently is, and to support the economy. So we don't think this will change the Bank of Canada's thinking at all around that. We continue to expect the Bank of Canada will hold in December and actually remain on hold through 2026.
Okay. Michael, always appreciate your insights on this. Thanks for joining us.
My pleasure. Thank you for having me.
Michael Davenport is a senior economist at Oxford Economics. Up next, Canada's housing market seems to be stuck in a slump. We'll take a closer look after the break. Fewer people were buying homes in October of this year compared to last, despite a drop in prices year over year. Now, that's according to the latest data from the Canadian Real Estate Association. For more on this, we're joined by BNN Bloomberg's Lindsay Biscay to talk about the numbers and some good news, some mixed, and the numbers vary across the country too, don't they?
They vary across the country, and they vary, when you look at year over year versus month over month, because, it's higher on the month, lower on the year. So we'll start with year over year prices, because that's what we were just talking about off the top there. So we saw a drop in home sales for the month of October compared to October of 2024. Just over 42,000 homes were sold last month. That's a drop from 4.3% compared to October of last year. When we're talking year over year, prices were also lower. New listings were up 7.2% from October of last year. But as you mentioned, that varies depending on what city you're talking about, what market across Canada. But then if you look month over month, you really start to see a bit of a change. Home sales up 0.9% on a monthly basis. That's the sixth consecutive increase over the past 7 months that we've seen an increase when it comes to home sales. So good news if you're looking month to month. New listings were down over month to month by 1.4%. And then the price of a home went up ever so slightly if you're looking at October compared to September of last year.
Now, there's all kinds of interesting markets depending on where you're looking and if you're selling or if you're buying.
Yes.
So the big question, of course, we can talk about up and down, but what's a house cost you?
Yeah, so the benchmark price of a house, it was up 0.2% month over month, down 3% year over year. So again, a bit of a drastic change if you're looking year over year versus month over month. The average price of a home, I believe, was just over $690,000. So it has dropped a little bit. But we spoke with Phil Soper from Royal LePage earlier this morning. He was saying it really depends on what city you're looking at as well, because as we talked about, it really varies when you're looking at different cities across the country. Toronto, Vancouver, and Calgary, for example, all saw prices drop for the month of October, but Montreal saw a 7% increase when it comes to the price, the benchmark price of a home. And again, Phil Soper talking about how that really has to be factored into what you're looking at here. Here's more on what he had to say.
If you were to look at home prices in a city like Montreal or Halifax or Edmonton, or moderately priced cities, home prices haven't gone very much up, but they've inched up the same way they're inching down in broad major metropolitan areas like Toronto and Vancouver. And then we have those special asset classes like the investor-friendly Toronto condo. They really got hammered under the very high inflation and high interest rates post-pandemic, and the cutback in temporary foreign workers and foreign students.
So I just wanted to check that number. So yeah, it was the average price of a home just over $690,000.
And of course, that depends on where you're shopping.
It depends on where you're shopping.
A big time. And economists say for 2026, we might see a little bit of change here.
Yeah, it looks as though most are optimistic that more people will maybe get into the housing market in 2026, maybe looking to buy a home. And that is because of a couple of different factors. So also prices dropping, as we see, the price of a home is slowly starting to tick down in most markets. Also lower borrowing costs, right? We saw the Bank of Canada cut those rates last month, and that's the fourth cut that we saw this year. Probably no more this year, but still lower borrowing costs allow more people to maybe get into the housing market. A lot of people were waiting after the pandemic, just a little bit of hesitancy, but there is potential that we could see a modest uptick in 2026.
Okay, we'll leave it on that note there. Lindsay, thank you. BNN Bloomberg's Lindsay Biscay. Well, we've seen a bit of a mixed day for the markets. All eyes are on the tech giant NVIDIA's earnings set to come out on Wednesday after the bell. Earlier, we were joined by John Zechner, chair and founder of J. Zechner Associates, to discuss if there are indeed fears over the AI-driven tech stocks and how they are affecting the market.
You're knocking out sort of two of the pegs that have kept the bullish argument going for the AI stocks for a while. The first one being the depreciation schedule people are suddenly worried about. It was brought up last week. Like all this equipment that's been put in and the growth has sort of using like 6 to 8 year depreciation schedules. And what if because of obsolescence and the need to upgrade more quickly, what if the useful life is more in the 4 to 6 year period? These companies are not depreciating the assets enough at a quick enough rate. And if they're not taking enough depreciation, you're overstating your earnings. And let's face it, earnings have been one of the great sort of backstops of the growth story of technology overall. When people say, well, it's different than 2000s because the earnings are better. Well, if not if the earnings are overstated. And then the other thing is, well, people might say, okay, well, earnings don't really matter. It's cash flow that matters. Like, that's just an accounting entry, depreciation effectively. It doesn't impact cash flow. Absolutely true. But what we've noticed is, and again, a second argument is that the free cash flow. The free cash flow was a great argument for these big tech companies for a year. They generate gobs and gobs of free cash flow. They were like banks. They were like large government or anything in terms of the cash balances they had. They could buy back stock. They could do acquisitions. But now, what we're finding is they're moving into a negative free cash flow, and after getting financing elsewhere, including the bond market. You saw Meta's deal for $30 billion in bonds. Alphabet has come in. Obviously, OpenAI is doing a major raise, even though they're not a public company yet. So the second argument that they've got this great free cash flow, that's not true. So then you start to worry about, okay, when you start to monetize AI, maybe there's a bit more of a rush to monetize this AI, because if these companies are, like I say, overstating earnings, and if they're not generating free cash flow, this story better start generating some profit in a hurry. So, we get the bar set a little bit this week with NVIDIA. I don't expect to miss, Andy. I mean, these guys have knocked the ball out of the park over the last 2.5 years. I remember back in early 23 when that first quarter, I think they were expected $9 billion in revenue, and they hit almost 11. And now you're looking at $54 billion, I think, the expectation for a quarter. So we know they get the lion's share. But, we saw good earnings from some of these tech companies that did not turn into great stock performance. Look at Palantir, Microsoft, Meta. So the bar is set very high. And, can they beat that? And, what are the sales to China, and how fast are they rolling over the equipment? So, what? Everybody's in the story. People love it. It's maybe a little bit overhyped, and some things coming up from the woodwork lately are a little bit reminiscent, I hate to say it, of the 2000 when you overbuilt telecom, and you had a different valuations model. Maybe it's better today, but maybe not that much better.
And apparently Peter Thiel, who knows a thing or two about tech investing, his hedge fund sold off its holdings in NVIDIA in the third quarter. It's now betting on Apple, Microsoft, and a reduced stake in Tesla. But interesting, so we get the NVIDIA numbers on Wednesday, as you know, after the close. Maybe you could put up a one-year chart. Interesting, a smart player like that backing away from NVIDIA.
Well, everyone's made a lot of money on these stocks, Andy, as you point out. And, they're shifting maybe to safer bets. I mean, obviously, you saw the thing on Berkshire Hathaway taking a stake in Alphabet as well, which, Alphabet, Meta stick out to me as more value-oriented plays in the sector. These guys will probably monetize AI sooner and better than anybody else, because they can deliver to their, clients through their apps or through their public clouds, which Google have, the benefits of AI more quickly. And they can, they can sort of benefit from that and sort of monetize it more quickly. So you can see people shifting to that and away from these high flyers that have no earnings, and you don't exactly know what the valuation is going to be. So we've reduced our bet overall in the sector, Andy. I mean, we're always going to be in technology. It's still a great growth sector, but right now, in terms of what we're adding in the portfolio, I'm looking more some of the beaten up areas, some of the tax loss selling candidates where I think you're creating a bit of opportunity if you've got a little bit of patience to ride these things through, because as you know, I mean, the one thing is sometimes good earnings are met with selling, but bad earnings have been absolutely decimated, and I think that's creating some opportunities out there.
One stock that you got your eye on is Northland Power. They just slashed the distribution. The stock tanked. Is that one you say shows potential?
Oh, absolutely.
NPI,
that's a classic.
sorry.
Yeah, NPI, that's a classic example of it. Yeah, trading now about 7 to 8 times forward cash flow, which is, great for renewables. I mean, renewables are out of favor, and that dividend cut, there's a lot of dividend investors out there, and that 27% sell-off or whatever it was the other day just wiped out the year's gains that had been actually a pretty good performer. But, I was on the conference call, and when you listen to what management was saying about why they missed it, it's really because, they're seeing more of opportunities available to them. I mean, there are 2 major projects, Halong Bay and then North Baltic, are coming along just fine. I mean, they're going to put them into production over the next year and a half or so, generating cash flow. And what they're seeing is more opportunities because, with what's going on with the U.S. administration and they're sort of move away from renewables. I mean, it's creating some opportunities for others with capital, but I mean, cutting a dividend is not the way to do it. And no, I've seen it a few. I mean, another name we're buying in here is Cargo Jet recently.
Okay.
Again, a bit of a disappointment on the numbers, is economically sensitive, but the stock got absolutely decimated. It usually trades at 10 to 15 times operating cash, so now it's down to 6 to 7 times. And then I noticed the founder came in last week and he spent $1 million buying stock himself, which I always love it when I see the founder, one of the original principals in there buying stock. So things like that. I mean, you got to have a little patience. Sometimes it's hard buying the dogs like that. I mean, but maybe it's just me. I'm a marathon runner, and I'm used to pain. Maybe that's it.
BCE, our parent company, you see potential there?
Another example, exactly, Andy, of that valuation. They cut the dividend. Everybody's come out of the stock. They dislike it. But look at the valuation of the tech or the telecom sector in general. I find it very attractive, and everyone's sort of poo-pooing the idea of what they're doing with Ziply and what they're doing with fiber in the U.S. I mean, BCE knows fiber well. I mean, they've done a great fiber build out in Canada, and all they're doing is levering that expertise a little bit into regions of the U.S. And I think it's a smart way to continue to grow within the telecom business. They've monetized some assets recently. They've sort of cut, obviously, cutting the dividend, improved their cash flows a little bit. And then when I look at the long-term valuations of all of these players, I think, I don't see much downside. I see a dividend yield protection a little bit, and I see some upside if investors come around to it a little. So I think sometimes you got to chase those opportunities, particularly this time of year, because in a year where you've had a strong market, and I've seen that in our client accounts, we're all, we've got a lot of capital gains this year, and people are sort of looking, okay, if I get any losses, I can crystallize as I reduce those gains, reduce my tax bill next April. And they're putting extra pressure on these stocks, and I think that creates opportunities. So like BCE, Northland Power, Cargo Jet, MDA Space, ARC Resources, it's a bunch of names that I've seen have been under pressure lately that I think will relent after that, and the valuations and the stories are still good.
And he was speaking with John Zechner, chair and founder of J. Zechner Associates. Coming up, Raymond James has initiated its coverage of Sunoco at Outperform. We'll have more on that and other market drivers with Bloomberg's Monique Monlin. That's after this. For more on what is driving trading today, we're joined now by Bloomberg Equities reporter Monique Molima. Monique, thanks as always for joining us. Got a couple on the way up, one on the way down. We'll start with one of the ones going up, Sunoco right now.
Hi, yes, thanks for having me. So Sunoco, they received some initiations today, as well as their company Sunoco Corp, which has direct investments in Sunoco, and also really positive on the stock. The company closed earlier this month on its acquisition of Parkland, which is a Canadian fuel distributor in the oil and gas space. And analysts really see that this is going to be able to help the company diversify in terms of its offerings and also geographically. This is going to help expand the business, and they also see potential for this to help deleverage the company and offer more revenue. So that's why we're seeing the shares up today, and a lot of analysts offering buy equivalent ratings on the stock. But they do note that there might be some heightened volatility from the fuel business from Parkland compared to Sunoco's original business.
Okay, and going the other way right now, Plug Power.
Yes, so Plug Power, they had their price target cut today at Susquehanna. They're a hydrogen fuel cell company, and they've seen some growth in their electrolyzer business. They've seen their cash flow improve with having less cash burn, a more balanced balance sheet at the end of the day. So they had some positive earnings last week, which analysts praised. But some analysts are starting to raise concerns about the hydrogen business. This company is working in hydrogen fuel cells and hydrogen power. And there's still some questions around what is the demand actually going to be. These are still technologies that are relatively new, not quite that widespread yet. So there's just some concern that maybe the demand isn't going to be as fast as people were hoping in the U.S. And that's why they're cutting their price targets, and that's what's weighing on shares today.
All right, but the other power people are liking right now, American Electric.
Yes, so American Electric, they received an upgrade at Jefferies today, and that's what's helping their shares go higher this morning. They are a utility provider in the U.S., and Jefferies said that they are the best positioned among all of its peers. They have contracted values, and they're also in the regulated space, which is something that can be less volatile, a little more stable in terms of investments. And they also are being seen as one of the companies that can capitalize on this data center growth. We've seen more and more of these AI data centers popping up all over the US, and they're going to need a lot more power than what's right now on the grids. And they see that American Electric is going to be one of those companies that can provide that power, that has the capacity to be able to reach that, and to be able to do it in a way that's still going to offer investors some security compared to some other of its peers. So that's why the shares are up this morning.
Okay, and we'll leave it there. Monique, thanks as always. Bloomberg's Monique Malima. Coming up, we'll dig into today's budget vote in Parliament and what it might mean for the Canadian economy and the markets. That's next. Inflation cooled less than expected last month, 2.2%. The figure was driven by a faster yearly decrease in gas prices, StatsCan says, while housing costs were a major contributor to monthly price pressures. Grocery prices saw the biggest monthly drop in more than 5 years. Some economists believe the data reinforces the Bank of Canada's view that interest rates can stay put for now. We're watching shares of TransAlta today. It is off by 0.49%. The company will acquire Far North Power Corporation and its 4 natural gas-fired facilities in Ontario. The deal is worth $95 million and is expected to deliver an immediate boost to TransAlta's free cash flow. TransAlta is aiming to seamlessly integrate the new assets while remaining focused on advancing its data center opportunities in Alberta. The deal is expected to clear early next year. Shares of Johnson & Johnson are edging higher after agreeing to buy Halda Therapeutics in a cash deal worth more than $3 billion US. It's up 1.63% right now. Halda is testing a new type of oral therapy as well as other treatments for multiple cancers. Johnson & Johnson has been looking to boost its pipeline as well as deal with declining sales amid competition from cheaper alternatives. And taking a look at the markets right now, the TSX still in the red right now. It's down 54 points, 0.18%. And south of the border, pretty much similar situation. Everybody's waiting for some direction, waiting for NVIDIA, those things. And here we go. So what's S&P 500 at 0.12%? It's down by. Dow Jones off by 0.17%. NASDAQ is almost a wash right now. It's off by 0.04%. Canadians could be heading back to the polls for another election if the Liberals' budget is shot down in a vote that is happening later today. CTV's Jeremy Sherrill has more in this report.
Inside the halls of power, high stakes to start the week. A crucial confidence vote in the House of Commons that could come down to the wire.
It's going to be a particularly dramatic and suspenseful day.
It could be close, like close as 2 coats of paint, real close.
Prime Minister Mark Carney's Liberal government will need help to pass its budget. 2 seats shy of the required 172 for a majority in the House of Commons, the government needs 2 opposition MPs to vote in support of their budget, or at least 4 members to abstain.
It's going to be about math. It's going to be politics. It's going to be about who wants to trigger an election. And the answer is no one really wants to trigger an election.
The Conservatives have been clear they won't support the budget, but leader Pierre Poilievre has stopped short of confirming whether all his MPs will vote.
Are you confident that all of your MPs will vote against the budget?
100% of our MPs oppose the costly Carney credit card budget.
The NDP has also signaled voting with the government isn't likely, but interim leader Don Davies has indicated his MPs could abstain.
I think they're going to have to finesse it because if all 7 of them came in and voted against the budget, it could defeat it.
The Bloc Québécois has indicated it'll vote against, while Green Party leader Elizabeth May has said she won't support it either, but could be persuaded otherwise, which means an election is on the table. with the outcome of Monday's confidence motion still unclear.
I think a lot of people hope that doesn't happen, but it's definitely a possibility.
Now, no party has indicated an election is what they actually want, but there is concern the numbers could be so close, a simple miscalculation could send Canadians back to the polls.
And that was CTV's Jeremy Sharon. For more on the possible implications of today's budget vote, we were joined earlier by Brooke Thackeray, research analyst at Global X Investments.
There's a lot of spending. It's a large deficit, $78 billion the first year, $321 billion over 5 years. And it's going to be hard to show that this actually pays off here a little bit. So my concern is the amount of spending that's going on overall.
Mm-hmm. Well, we saw there was a report out from the interim parliamentary budget officer on Friday that had some concerns that some of the accounting, when it came to investments and tax credits, and that it might not be the way it should be done. And he also had concerns about the fact he doesn't think they're going to meet that the deficit dropping down, but the deficit ratio, it doesn't think it's going to change over the next 4 years. He's not optimistic that can happen.
Yeah, I mean, usually with budgets, most of the time governments actually spend more than they say they're going to spend, and there's something else. And on top of that, there's very aggressive assumptions being built into the budget as far as growth goes, and there's no recession built in there. And I'm not saying it should be different, but that's the way it's done.
Yeah.
So there's risk to those numbers with the deficits and debts going up. And that's gonna have an impact, because that means more government borrowing, which means we probably will see higher interest rates really have an impact here, because it's going to be more expensive for governments to borrow, the Canadian government to borrow over time. So there's a lot of risk, and you have to show that that's actually paying off, in the end. And that's going to be the difficult thing.
Well, and I think and that's what they're trying to argue. They're not taking into account how the spending is going to increase income coming in and increase strengthen the economy. But is that a realistic expectation, you think?
I don't. I think
tough question, but
I don't think it's a realistic expectation. I don't think we're going to see the growth that's going to overcome the amount of spending that's taking place here. The focus has really been on government approved projects, basically, versus through the private market and fixing the supply side. Which would be very different as far as removing regulations and making it easier for companies to start business and really proceed. So it's really been focused on that. So I'm not convinced that we're going to see the amount of growth that is sort of saying, hey, this is where we expect things to develop from here.
Why do you think they're staying away from that, cutting regulations and removing some of the red tape?
Yeah, I think they're just they're saying the government's the more important factor. There's a lack of focus on private companies here, really, overall. I think they're saying, well, we can provide the answer here. And they're not the only government in the world that's doing that at this point. But that's been their solution here. And I really think it would be, I'd love to see more of the red tape being removed.
What's some of the biggest red tape to you?
Well, I mean, if we start to get into the energy sector, we really don't have a plan to say, here's what we want to do as far as removing some of the regulations, as far as the pipelines being built. Because oil companies are really looking for a 20-year plan. They're not going back and forth. They want commitment to say, here's what has to happen, rather than, we're going to leave the caps on, or whatever it is, or the tanker ban, et cetera. We're going to leave all that there, but we're going to have a couple of exceptions. That's not going to really encourage private companies to come in and expand outside of their few exceptions that the government's going to force through overall. I think the better play would be to actually just change the regulations so that companies are incented to actually set up shop.
I was speaking with Brooke Thackeray, research analyst at Global X Investments. Coming up, the Committee of Internal Trade is convening this week. We'll talk about what that means for Canadian small businesses after this. The Canadian Federation of Independent Business is keeping an eye on this week's Committee on Internal Trade meetings. From the meetings, the CFIB is hoping the government will work on expanding mutual recognition agreements between provinces in food, labor, alcohol, and services. That's just some of the goals. They have a lot more too. Here to talk more about that is Ryan Mallow, Vice President of Legislative Affairs at the CFIB. Ryan, thanks very much for joining us.
Good morning. Thanks for having me.
What would be a win for your group to out of these meetings?
So I think first and foremost, something that's truly tangible in terms of progress. We've seen a lot of really positive momentum this year, especially at the beginning of the year. All the provinces and the federal government have been saying the right things. We've seen signing ceremonies. It's all been in the right direction, but none of it's being felt on the ground. And we want to make sure that we are able to take the next step and actually deliver tangible on-the-ground differences for businesses, which means when trading across provinces, they're just able to do it. They're not having to look through the next province's rules, figure out what they need to comply with. The mutual recognition is there to ensure that they can just trade.
And what are the next steps you need?
So I think it's the mutual recognition that 9 provinces have passed legislation on to actually be implemented. I think one of the challenges that we've seen in a lot of the legislation, Nova Scotia, Manitoba, Ontario, is that mutual recognition has been contingent on another province sort of moving first or along with them. And it kind of has a little bit of a stalemate going on where I think Nova Scotia is in the lead right now, Manitoba close second, have agreements with some provinces, but not all provinces. What we'd like to see come out of this meeting is just sort of a blanket acknowledgement that, if we're going to move towards one Canadian economy, then one set of rules should work, mutually recognizing everybody's rules so that we can move forward would be the best way to do that.
And it's been, I guess, about 8 months roughly. Are there some victories for you so far?
Again, I think we've seen some progress in the sense that we have seen 9 provinces come forward with legislation. I believe Newfoundland and Labrador is the last holdout. The new government there is committed to moving forward. We are seeing some progress on things like the alcohol file and that there are commitments to allow direct-to-consumer alcohol shipping. But even then, that commitment right now is slated for May 2026. Manitoba allows this, has always allowed it. We can just do it. We'd like to see governments actually move, put a little bit more action behind the positive words that we're hearing so that we can get things done and get goods and services moving within Canada.
And now the other one you're concerned with is food. What are the issues there for you?
So one of the biggest frustrations that we hear about food is that anything that is provincially inspected isn't allowed to move across borders. So for example, if you are a butcher in Ottawa, you cannot move things across the river into Gatineau. If it's provincially inspected, it has to be federally inspected, despite provincial inspection working for consumption in Ontario. Having some mutual recognition on that and just acknowledging that if it's good enough to eat and consume in one province, that should be good enough for the other province would be huge. There's federal involvement in that too. It's the CFIA that is largely there, but we would like to see those rules, again, mutually recognized in something that's all-encompassing so that we can move those goods across provincial borders without the additional layer of red tape and federal inspection.
Now, that doesn't seem that difficult. I would hope most of the provinces probably have very similar food standards, cleanliness and things like that.
You really would hope so, but the town of Lloydminster is a great example. It stretches the borders of Saskatchewan and Alberta. I think it's a highway that separates the middle of the town. It was only this year where businesses on one side of that road could transfer their products to the other side of that road when provincially inspected as part of a federal pilot program that lasted a couple years. But that's how silly that this had gotten. So while it is something that can be done, we've seen it be done, to date it hasn't. And so we're hoping that this meeting they can hash out their differences and get it so that, again, we can just get goods moving.
Now, I know you want to see continuous progress, but are there some things that the government could do now that would make an instant difference?
So I think it's sort of walking their talk is what would really do it. We've got the legislation in place. There's either the sort of mutual recognition. If you recognize, I'll recognize a number of provinces. BC, Quebec, and the feds have taken a slightly different approach, a little bit more regulatory, but perhaps broader. Everyone kind of has the mechanisms in place. It's enacting them broadly that we're really looking for. And the concern is that if they can't come to sort of an agreement across the board, what we're going to wind up seeing is functionally sort of individual trade agreements between every single province. So instead of having one governing piece of legislation or blanket recognition of rules, we're actually going to have dozens of rules and regulations that businesses will need to go through. And that's something we don't want to see. So I think just sticking to what they've committed to and actually enacting it would be the major step forward.
Okay. Ryan, thanks very much for joining us.
Thanks for having me.
Ryan Mallow is Vice President of Legislative Affairs at the CFIB. Up next, we'll take a closer look at Canada's latest inflation data and what it means for the housing market. That's next. Canada's housing market bounced back in October, with national home sales climbing 0.9% in September. The latest Canadian Real Estate Association data shows that the benchmark price of a home rose 0.2% on a seasonally adjusted basis, and the number of new listings declined. For more, we were joined earlier by Philip Soper, CEO of Royal LePage.
It's been a while since the pandemic boom, and people are having babies, getting new jobs, looking for new housing, but for many of them, they have delayed making those big decisions.
The benchmark price, though, still down 3% year over year, and way down from its peak of more than 2 years. Well, substantially down, let's say, from its peak of more than 2 years ago.
Yeah, and that is pulled by certain classes of properties in certain cities. For most places in the country, home prices have been treading water for, well, a few years now.
That's interesting. You're talking in particular, I guess, Toronto and Vancouver. I mean, they, especially for condos, for example, they've seen serious weakness.
Exactly. If you were to look at home prices in a city like Montreal or Halifax or Edmonton, or moderately priced cities, home prices have actually haven't gone very much up, but they've inched up the same way they're inching down in broad major metropolitan areas like Toronto and Vancouver. And then we have those special asset classes like the investor-friendly Toronto condo. They really got hammered under the very high inflation and high interest rates post-pandemic, and the cutback in temporary foreign workers and foreign students.
It's interesting how difficult it seems to be in places like Ontario, though, to increase the supply of housing. One problem being that a lot of the speculators who bought properties to rent them have come out of the market. Demand has collapsed around Toronto for condos, for example.
Yeah. And you know, speculators is a broad term, actually. There are a relatively small slice of buyers in the market who are what we call flippers. We don't like flippers. They try to buy low and sell high. Of course, they've been out of business since the pandemic because there hasn't been enough activity in the market, enough movement in prices to make a flipper's world work. But if you're speculating in terms of buying a condominium as an alternative to an RSP and holding it and becoming a landlord for a number of years, that's been a tough market. The math has been hard to make work.
And it sounds like we got, let's face it, substandard housing. In Toronto, I'm talking about tiny apartments that people don't want to live in.
Yeah, you know what we're finding selling in the condominium sector are condominiums with parking. And you think, well, don't most condominiums come with parking? Well, yeah, if you live outside of downtown Toronto or potentially Vancouver. But for a period of time over the last 15 years, that was a really popular form of condominium. And well, we're not Manhattan, and people do still work partially in the office, partially out of the work, despite back to office mandates, which means they want transportation to get out of the city when they are not, living and working downtown. So, yeah, we've got a mixed problem in our biggest city.
That's interesting. Just give us that again. For example, in Toronto, I apologize to viewers who are being a bit Toronto-centric here, but condos that don't have parking are proving a tough sell?
Yes, condos that are, and those tend to be small condos too, but the real gotcha is no place to park a car, which means you're a true urbanite, and we obviously have those that don't use a car, don't need a car, never leave the downtown core, and if they do, they rent a car, share a car. But for the majority of people buying homes now, and remember, our biggest cohort demographically is the millennials, even bigger than the baby boomers, and they aren't kids anymore. We've got 45-year-old millennials. So they want a car, and they can afford one. They just need a place to park it.
It's interesting, just finally, we know we've got slow population growth in many countries. That's why in Canada we bring in immigrants. I've seen some research suggesting that the fact people can't get a reasonably sized place to live is discouraging them from having kids.
Oh, absolutely. Urbanization is one of the major drivers of low birth rates. People who live in urban areas have access to alternatives, and people who live in non-rural areas tend to stay in school longer. I'm speaking specifically about women. They have their kids later. I think it's about 8 years over 2 generations. The first kid is now early 30s. It used to be, call it 24 years old when baby boomers were having kids. Now it's about 32. So yeah, fewer children, and a lot of that relates to where they live.
And Andy was speaking with Philip Soper, CEO of Royal LePage. Market Call is coming your way, and today on the show we have Eric Nuttall. He is partner and senior portfolio manager at 9 Point Partners. He'll be taking your questions on energy stocks. And let's see how the markets are doing right now. Take a quick peek. We'll go to Bay Street first. Take a look at the TSX right now, and you can see it's still down a little bit. It's waiting to see what happens, a lot of people reacting to that inflation data that came out. But there are some winners today. Curaleaf is bouncing back. It was taking a hit. It's up about 4.84%. And Sienna Senior Living also is up right now about 3%. But when you go the other way, there are some losers to deal with right now, or those that are down. Stantec, some mining and energy situation. Stantec is off by about 4.5% for today. And Discovery Silver also down 4.2%. And the third worst on the market right now is CES Energy. It's also off. And as you can see south of the border, the numbers are kind of mixed right now. You pretty much a wash except for the NASDAQ. It's actually bounced back. It's up 0.29% right now. Dow Jones almost a wash. And the S&P 500 up by 0.14. Thanks for watching Morning Markets. We'll see you tomorrow.